There are already plenty of companies that generate electricity. The real question that is changing the rules of the game in the energy market right now is different. It's not about where and how to generate electricity, but rather when to store it, when to use it, and when to sell it to maximize profits. This question is completely changing the game. The company we'll talk about today is a bit unusual. There are no solar panel factories and no battery cell lines. Instead, we are focused on using artificial intelligence to operate assets like solar power plants, large battery facilities, and electric vehicle charging stations that are spread across the globe to generate profits. The ticker on the New York Stock Exchange is STEM. Let's imagine a scene for a moment. In a certain city, there is a massive battery energy storage system. Solar panels are installed on building rooftops and fields, and electric vehicle charging stations are set up throughout the parking lots. The common point of all these facilities is one, depending on when and how they are used, the same facilities can yield completely different profits. If you charge the battery when electricity rates are low and discharge it when rates are high, you can profit, but if you miss the timing, even expensive equipment can easily become unprofitable. This is precisely the point that defines the identity of the STEM. At the heart of this company is an AI-based platform called Athena. If we were to define a system in one sentence, we could say this: the batteries are made by other manufacturers, and we optimize profits by managing those batteries, solar facilities, and electric vehicles with software and data. Therefore, STEM is more of a clean energy operating system that optimally manages energy assets than just a battery company. Athena receives real-time data such as the status of batteries and solar power systems at each site, wholesale electricity market prices, weather, demand patterns, and electricity rate systems, and makes these decisions instead of people. Electricity prices are low right now, so let's charge the batteries. It's currently peak rate time, so let's discharge the batteries to reduce electricity costs. Now that the wholesale market price is good, let's sell electricity in the market, and this judgment will automatically lead to actual equipment control. Here, another axis of solar power monitoring overlaps. STEM acquired a solar software company called Also Energy in 2022. The PowerTrack platform developed by this company was a solution that monitored and controlled solar power plants, with over 30 GW capacity in more than 50 countries around the world. Now, PowerTrack and Athena have been integrated within the STEM framework to evolve into an energy management system that manages solar, battery, and hybrid projects together. Recently, we are envisioning a strategy that integrates our product line under the name PowerTrack Energy Management System, directly targeting large utility projects. According to official data, the managed assets in solar power have surpassed the mid-30 GW range, and energy storage assets are also gradually increasing. The exact numbers vary slightly each quarter, but it is clear that the company is one that manages energy assets from various countries on a single platform. By bundling solar power, storage devices, and electric vehicle charging infrastructure, the reason why STEM is interesting lies in this business structure. First of all, STEM does not produce batteries directly. We combine hardware made by large battery manufacturers and inverter companies on a project-by-project basis to create energy storage devices. And then we layer software and operational services like Athena and PowerTrack on top. In other words, it is more accurate to view us as a company that sells the brain, that intelligently manages clean energy assets instead of building battery factories. The actual work that the STEM does is divided into 3 branches: designing and supplying energy storage projects that integrate large batteries, inverters, and measurement equipment, building subscription-based revenue by layering AI software like Athena and PowerTrack on top of this project. This is a service that operates and manages the recently completed facilities for a long time, even handling transactions in the electricity market. In this structure, hardware sales are more of a means and what the company wants to grow. The most is the recurring software and service sales that come in every year. Now, let's take a look at the numbers to see how much substance this story actually has. STEM announced its Q3 2025 results on October 29, 2025. This quarter's revenue was $38.2 million, representing an approximate 31% growth from $29.3 million in the same quarter last year. Looking at the gross profit under U.S., GAAP was $13.5 million, with a gross margin of 35%, while the adjusted gross profit was $17.9 million, with a gross margin of 47%. Considering that the total margin in the same quarter last year was in the low 20% range, it shows a significant improvement in the profit structure by reducing the hardware proportion and increasing the software and service proportion. The net loss is still minus $23.8 million. However, compared to a net loss of $148.3 million in the same quarter last year, the loss has noticeably decreased. The adjusted EBITDA was a positive $2 million. In the same quarter last year, it was negative $3.5 million. And this quarter marks the point where we recorded adjusted EBITDA in the positive for 2 consecutive quarters. The cash flow from operating activities is also significant. In the same quarter last year, the operating cash flow was minus $9.4 million, but this time it has turned positive at $11.4 million. Looking at the annual recurring revenue, which is a key metric for software companies, STEM's annual recurring revenue is around $60 million, showing a growth of about 17% compared to last year and about 3% compared to the previous quarter. As the proportion of subscription revenue gradually increases, we can see this as a phase where the platform business is gaining traction. According to the company's annual forecast for 2025, revenue is expected to be between $135 million and $160 million. Adjusted gross margin is targeted between 40% and 50%, and adjusted EBITDA is aimed to be between negative $5 million and positive $5 million. Although the net profit is in the red according to U.S. accounting standards, revenue is in the double-digit growth range. Margins are improving as the structure shifts towards software-centric models, and adjusted EBITDA and cash flow have turned positive. In summary, we can say that the clean energy startup, which initially showed significant losses, has entered a transitional phase where it is gradually sorting out its numbers as its actual business model begins to gain traction in the market. Let's take a look at the stock price. As of November 2025, when this video was prepared, STEM's stock price was approximately 18 based on the closing price. Throughout the day, it fluctuated between the mid-17 range and the high 18 range, with a trading volume of around 250,000 shares. Compared to the peak recorded during the initial SPAC boom, the current price is still quite a bit lower. Although the performance structure has improved this year, the market is still more in a wait-and-see mode, rather than having fully reevaluated the company, keeping one eye on whether it can truly establish itself as a software-centric energy platform company. Now it's time to consider both the opportunities and risks ahead. Looking at the opportunity factors, as the energy transition progresses, resources with fluctuating outputs like solar and wind energy are increasing. As this happens, the importance of energy management software that determines when to store electricity, when to use it, and when to sell it can only grow. STEM defines itself as a leader in AI-based clean energy software and services, and it is directly targeting this point. Another opportunity is that the proportion of software and subscription revenue is gradually increasing as companies focused on hardware inevitably experience significant fluctuations in performance based on project contracts. But as subscription revenue accumulates, margins and cash flow can stabilize gradually. The solar monitoring assets secured through the acquisition of Also Energy can also become a leverage point in the future. The fact that we are already managing large solar power plants in several countries and controlling data will serve as a strong starting point when integrating solar power, storage devices, electric vehicles, and the grid into a single platform in the future. As we saw earlier, the fact that the adjusted EBITDA has consistently recorded positive figures, total margins have risen to around 40%, and operating cash flow has turned positive, can be interpreted as a signal that the business model is now actually starting to work. On the other hand, the risks are also clear. It is still a small company that is operating at a loss according to U.S. accounting standards, with annual sales remaining between $10 million and $20 million. The performance can be significantly affected by factors such as the economy, interest rates, government subsidies, and the timing of securing large projects. The competition is fierce. In the utility-scale energy storage market, We have to compete with large energy storage companies like Fluence, as well as players like Tesla, who are pushing to integrate batteries and energy management systems. In the energy software sector, we also have to face solutions developed by power companies themselves or other SaaS providers. STEM has declared its intention to reduce the share of low-margin hardware and shift towards a software and service-centric structure. In this process, the quarterly sales and order flow may appear to be erratic at first glance. Above all, this company is still a growth stock that is operating at a loss. Even a slight dip in performance, compared to market expectations, can cause the stock price to fluctuate significantly. So here's a realistic one-line summary. STEM is not a factory that produces batteries, but a clean energy software and platform company that uses artificial intelligence to operate batteries, solar power, and electric vehicles. In the era of energy transition and artificial intelligence, it is a company that sells the brain to calculate when to store electricity, when to use it, and when to sell it. Currently, it is in a transitional phase, expanding its business scale while reducing losses. When compared to hardware-focused energy storage players like Fluence, Energy Vault, or EOS, it becomes clearer that STEM stands on the same energy storage board, but on a completely different layer, namely the software layer. This story is a piece of the vast infrastructure map that connects search, YouTube, AI chips, and foundries, corresponding to the power and energy operating system. As we follow the other pieces connecting energy, artificial intelligence, and semiconductors in the future, we will gain a clearer view of the structural framework that underpins the world system we live in. To check the global infrastructure map, please like, subscribe, and turn on notifications.